global economics and is live with us here in the studio. Jürgen Michels is Managing Director at Citigroup Global Markets. He joins us live from the City of London. Megan, let me just kick it off with you. You now think that actually it is very likely that Greece will have to leave the euro, but you say there's no chance of this being an orderly exit.
Well, I think there's an 85% probability that Greece will end up exiting the Eurozone. The only way to avoid it is if the core countries were to set up a fiscal transfer union for Greece, and I don't think that's very likely at all. I do think, actually, that it can be orderly and managed and negotiated, though. I think it's in everybody's best interest, and so I actually think that that's the most likely option. That being said, the recent political drama in Greece absolutely increases the risk that not only could a Greek exit happen earlier than I expected, so it could happen this year, but it could also be disorderly and unilateral. And obviously the impact on the rest of the region would be much bigger then.
And Jürgen, you actually put the probability of Greece leaving the euro at between 50 to 75%, so you also increase the chances of this happening.
I think we see that we have a probability around, yes, as you say, up to 75%. There is still some small chance that after the election we may have a government that is willing to accept the memorandum of understanding. But as I say, it's a very small chance, and in that respect we may see developments in Greece to come through very quickly. And we have had several comments from officials from the European Union, but also many member states, making clear that there is a quid pro quo. So you only get further assistance from the Union if you are willing to accept this memorandum of understanding. And while there may be some measures to amend a few things of the program, maybe through additional growth supporting measures, through cohesion funds and other things, I think there is no room to negotiate really the signpost of this memorandum of understanding. And that makes it very likely that Greece has to leave, maybe even the next couple of months.
And if it leaves in the next several months, is it going to be an orderly exit? We heard from the Malaysian central bank governor today, and she was saying actually this could be a disaster. This could plunge Europe back to what Asia saw in the 1970s.
I think it can't be orderly because there is no script how we go through this. The only way what you can do is try to contain the contagion in other countries, and they have some facilities in place. The EFSF, the ECB can do lots of stuff, but we probably need more measures to limit the contagion on other places, and in that respect you probably have to come up with some guarantees for bank deposits in some countries, and also thinking about a facility to recapitalize the banks, something along the lines what the ECB has proposed in terms of this resolution funds. But all those measures will take time before they go through. In the meantime, the ECB probably has to come in with significant measures to calm the situation.
Megan, are we ready? Is the ECB ready? They've had enough time.
Yeah, that's right. I mean, I think nobody really knows exactly what will be unleashed when Greece does default and exit, but I do think that the ECB is the one institution that's poised to step in fairly quickly compared to the other European institutions. And I think, we're already seeing deposits flee from Greece. I think when Greece does exit, we'll see bank runs in Portugal and Spain, and I think that the ECB is poised to step in and try to plug that gap with liquidity measures like the ELA programs or, future LTROs.
Of course, the most important, if Greece does exit, is, do we have this firewall against that will stop anything coming out of the bigger countries? Do you think that has been put in place, or will it open a whole new can of worms? Are markets going to be tested again?
Right. It hasn't been put in place yet. They've gotten money pledged to a firewall. They've cobbled together where the source of the funding is, but the money isn't actually there. And so if Greece does default and exit in the next couple of months, Spain is going to need a bailout the next day, and the money actually isn't there yet. And so in my view, the Troika is incentivized to blink in this standoff between Greece and the Troika. That's one of the biggest reasons, because of concerns about Spain. Over the past couple of days, we've seen, as drama has risen in Greece, Spanish bond yields have gone right up, and that's partly to do with Spanish fundamentals, but it's partly to do with contagion.
Jürgen, are you concerned that Spain will need a bailout? So far, the government has said that actually they should be fine, but we saw this bank recapitalization not working as well as it should have.
We've argued for a while that at some stage Spain very likely needs assistance from official lenders, and when it comes to the full-fledged program or assistance through the secondary and primary market operations from the EFSF or the special function to provide funding for the banking system, that's open. But we think that in an environment of more stress caused by the situation in Greece, but also looking at the underlyings in Spain, that it is very likely that we need this support later this year.
Megan, let me just start with you in terms of what we're seeing in other countries. Now, before the break, we're talking about the possibility of Greece exiting the euro. You put that now at 85%, and the chances of Spain needing a bailout and what they will do, the European Union will do to actually firewall. But we also have other unknowns, and Italy is one of them. It seems that Mario Monti is doing a good job, but do you have, the full confidence that he is the right man for the job? He didn't push some reforms which he could have done.
Yeah, that's right. Monti has watered down some of the labor market reforms. And also, more importantly, Mario Monti's only in power until next April when Italy has an election, and it's unclear who will emerge victorious after that election. But it is clear that there will be some form of gridlock in the Italian government, and so the pace of Italy's structural reforms may slow, and probably will. And so that's worrisome in terms of Italy restructuring its economy. But Italy has fundamentally looked much better, in my view, than Spain has all along. Unfortunately, the markets aren't making that distinction. So as we've seen Spanish bond yields rise, Italy's have been right behind them. And so I do think that when Spain needs a bailout, and it's a question of when, not if, Italy will be pushed right into one immediately thereafter.
Jürgen, do you agree? Will Italy also need a bailout if Spain gets one? It does seem that the markets are indiscriminate, but at the same time the banking sector in Italy is a lot more healthy than in Spain.
I think Italy's banking sector looks healthier, the private sector looks healthier, but the big problem is in Italy the huge debt of the sovereign and the very poor performance of the economy. And in that respect, we are likely to see further disappointments. We just do not only have potential growth rate according to the IMF of -0.4, we also see that the additional fiscal tightening and also the problems coming from the funding issues on the banking side will lead to a further downturn of the economy. So all the projections of getting back with a budget surplus or a balanced budget in 2014 looks to be overdone. And of course, if the pressure goes on to Spain, I think Italy will come into focus, and we have argued later last year that in that case you probably get to a situation that Italy needs some external support as well. So I think this is likely to continue, and if the pressure goes on, we will see probably more countries really coming into severe problems.
And Jürgen, what about France? I'm not suggesting that needs a bailout, but certainly the banks will have a tough time if Greece leaves the euro. They haven't done enough write-downs, have they?
I think there's probably more problem coming up on that front, but I think France is far away of needing some external help. But we will see increasing market pressure, what will probably challenge the plans of Mr. Hollande to go ahead with some delay of the fiscal adjustment procedure and the amendments in that front. So I think markets are likely to focus also on those countries that are in the soft core.
Megan, are you concerned about France? It seems it's too early to say, I guess, but François Hollande may have actually tempered his need to renegotiate, for example, a fiscal pact. At the same time, there is still a huge problem with the French banks.
That's right. I'm not as worried about France as I am the other weaker countries in the Eurozone because of France's external debt position. It's nowhere as extreme as elsewhere in the Eurozone. But I do think that there is an interesting political dynamic between Merkel and Hollande, and that Merkel has always embraced bond vigilantes as disciplinarians. And so I think that Merkel will allow the markets to put pressure on France to rein in its fiscal dynamic. And I do think that Hollande will continue to fight for a growth compact to run alongside the fiscal compact. And that might help on the margins, but looking at the proposals on the table, they will only help at the margins. And it will take a long time to actually agree on measures, implement them, and have them actually feed into the real economy and support growth. So I don't think that will be a game changer in the Eurozone.
All right, thank you so much to you both. Megan Greene there, Senior Economist at Rubini Global Economics, and Jürgen Michels, Managing Director at Citigroup Global Markets. Thank you to you both for your time.